As we navigate the various stages of life, money remains important, always. But it's also true that our priorities about money change. As we get older, we move from earning and saving, to spending and acquiring, to eventually a priority on safeguarding our money, shielding what we've accumulated from risk. If this is the stage where you find yourself, concerned about protecting what you have, then this presentation is one you'll want to see, because it tells the story of a remarkable financial company that has created a remarkable financial vehicle. It's called Aquila, a fixed indexed annuity, a vehicle for protected tax-advantaged savings, and much, much more. Why is Aquila remarkable? Because of three facts. First, Aquila protects your savings. There's no investment risk ever. Second, Aquila offers multiple ways to earn interest on your savings. And third, Aquila will pay you a monthly income that you can't outlive. Here's a simple truth. A company and the financial vehicle it offers are inseparable. A good vehicle from a subpar company is no better than a subpar vehicle from a good company. But when both are excellent, when a multi-billion-dollar company which has delivered exceptional performance since the 19th century introduces a financial vehicle that is no less exceptional, well, then you have that rare opportunity for something that is truly special. And that is exactly what has happened with the introduction of Aquila. It delivers what may be the most compelling value proposition ever offered in a financial vehicle: the potential for gain without the risk of loss. More than that, the essential ingredient of a secure retirement, an income that lasts for life. Let's take a moment to look at this issue of income and understand why nothing is more important once you retire. I'm going to share three principles that you should always remember. The first principle is, no retiree stops needing income. Whether you are 66 or 78 or 95, bills must be paid. So a monthly paycheck that you can count on to be there, even if you live into your 90s or beyond, well, that is what represents true income security. The second principle is, in retirement, it's your income, not your savings, that creates your standard of living. Your income is what pays your bills in retirement. If your income drops, so does your quality of life. The third principle is this. The income-producing value of money changes all the time. You should assume that it will change when you are retired. Let's look at an example that shows how these three principles can merge together in someone's retirement to damage financial security. We'll have to take an imaginary trip back to the year 2000 to meet a retiree named Sue. Sue had been a good saver. She entered retirement with $500,000. But because she also craved safety, Sue took her money to her local bank, where she was advised to purchase 6-month CDs, paying an interest rate of 6.97%. And she happily collected interest income of about $2,900 per month. Now let's fast forward this story 14 years. Now well into retirement, Sue remained no less risk-averse than when she first entered retirement. But something dramatic happened. The interest rate paid on her CDs plummeted to just 0.28%. This drove her monthly income down to only $117. And if we bring this story forward another 7 years to 2021, the interest rate had fallen even further to only 0.10%, giving Sue a monthly income of only $42. The point is this: Sue's savings, her $500,000, never changed. but its income-producing capacity changed a lot. This type of soul-crushing loss of income was experienced by many retirees in the United States when interest rates collapsed to near zero. When this happens to a retiree, it's simply devastating. Remember, it's your income, not your savings, that creates your standard of living. This is why, financially, nothing is more important to a retiree than income. So a smart decision for a retiree to make would be to somehow lock in the payment of income, ideally at a competitive rate, and ideally for life. And that is exactly what Aquila enables you to do. Here's an example. Imagine a retiree who is 66. We'll call her Nancy. Let's say Nancy places $500,000 in Aquila. The annuity would guarantee her an income factor of 4.6%. What does that actually mean? Well, you might think it means that Nancy would receive an income of $23,000 per year. $500,000 multiplied by 4.6% equals $23,000. But it's actually better than that. You see, when you place money in Aquila, you are credited a bonus on the premium. Premium means your deposit. Insurance has its own vocabulary. At age 66, the bonus is guaranteed to be 10%. So when calculating the income, the 4.6% income factor applies to $550,000, not $500,000. That means $25,300 of income, or $2,108 per month for life. With Aquila, you never have to worry about your income running out. Now, while protecting your savings and paying lifetime guaranteed income are key features of Aquila, the annuity, of course, credits interest. This is a story of innovation that is truly impressive. GCU has partnered with Barclays, the prestigious global bank headquartered in London. Like GCU, Barclays also has a rich history. Its roots date back to 1690. As of 2022, Barclays had assets of $1.8 trillion. Aquila's interest growth potential is based upon the performance of two indices sponsored by Barclays. The first is Barclays Zorya Index, a portfolio of US stocks and bonds. The index uses modern portfolio theory to enhance returns and manage risk. The second index is Barclays US Tech Index. This index seeks to capture the returns of the 100 largest non-financial stocks listed on the Nasdaq by market capitalization. When you own an Aquila annuity, you can choose which index you'd like to have your interest crediting based upon. Or you can allocate a portion of your savings to each index. Moreover, you may select from two interest crediting strategies, a 1-year strategy and a 2-year strategy. With the 1-year strategy, index growth is measured from the date your annuity is issued to its first anniversary. Let's assume you have chosen the Zorya Index and that it grew in that first year by 9%. Your Aquila annuity would be guaranteed to receive 100% of that increase, or 9%. In year 2 and every year thereafter, the index growth is measured over succeeding 1-year periods. GCU guarantees that during the first 10 years you own your annuity, you will never receive less than 100% of any index increases. Now, what would happen if the index did not perform? Let's say the performance of stocks turned downward in year 2 and the index declined by 8%. Unlike investing, you would not share in the loss. For that year, you would earn no interest, but your principal would remain secure. This approach will appeal to savers who want the potential to earn greater levels of interest, but who do not want the risk that comes along with investing. Imagine that over 10 years, the index produced 7 years of gains and 3 years of losses. Interest would be credited to the annuity 7 times, equal to the actual gains in the index. Now, what I'm going to say next is important because it highlights a fundamental difference between investing versus saving with Aquila. Although the index declined in 3 of the 10 years, Aquila protected against any losses. While no interest was credited in those 3 years, the annuity's cash value was always secure. The interest earned from the 7 positive years was locked in. Whichever index you choose, the fundamental advantage remains: the potential for growth without the risk of loss. If Aquila's benefits stopped here, you might consider it a spectacular choice for your savings. But there are more benefits to mention. Beginning in year 2, Aquila offers a nursing home benefit that allows you, after 90 days of nursing home confinement, to access up to 100% of the annuity's account value with no withdrawal penalty. Once you reach the age when you begin receiving lifetime income, Aquila provides a wellness benefit that allows penalty-free withdrawals if you require home health care. There are more benefits than even these. Your licensed insurance agent will provide details on all of them. But with all of the advantages I've described, you may be thinking, where's the catch? Can Aquila really be this good? Well, it really is. However, there is a surrender penalty in the event you cash in the annuity during the first 10 years. The surrender penalty is based upon a sliding scale. In the first year, it is equal to 9%. It then reduces by 1% per year until year 10, when the penalty is 1/2 of 1%. After 10 years, there is no penalty. You may be thinking, what if I need to access money during the first 10 years? I'd rather not pay a penalty. And in fact, you can avoid a penalty simply by limiting your annual withdrawals to no more than 10% of the annuity's account value. Unless there is an emergency, retirees rarely need to withdraw more than 10% in any given year. But even if an emergency did occur, a terminal illness, confinement to a nursing home, or the need for home health care, in most cases there would be no penalty assessed in any case. So when looking at the entire picture, it's clear that Aquila offers savers a constellation of important benefits. At the beginning of this presentation, I referred to Aquila as a remarkable financial vehicle. I hope that now you see why. If protection, the opportunity for growth without risk of loss, and the security of a lifetime income are advantages that appeal to you, tell your insurance agent that you wish to put Aquila to work to enhance your savings. At a time of economic uncertainty, it's the way to make your retirement stronger and more secure.